Welcome back. The picture across Asia is mixed, as we've been telling you, but it's more up than down. One would have to say the Hang Seng is the only market that's slightly lower, which is why the overall pre-open indication for us, that's the market that's actually down. The overall pre-open indication is that we could still be starting off positive. There we go, 66 points on the higher side as far as the implied open is concerned. Now let's talk about stocks. Plenty of them as always. So let's straight away get to the CNBC-TV18 list of top stocks to watch. And guys, morning to all of you. Happy Monday to all of you. Nigel? JSW Steel, how does the performance look?
Well, the numbers were in line and the performance will improve from here on. And so that's why I'm going with green. The numbers should come up for you on the screen, what they've reported on a consolidated basis. That compares with our poll, more or less in line out there. The EBITDA number, well, that improved on a standalone basis as much as expected, came in at around 8,800 rupees per ton, which was our expectations. Focusing a little bit more on the standalone business, because that's where the majority of their value does come in from there. The volumes have improved out there, clock close to around 5.77 million tons, so a bit of operating leverage has played out. Lower cost as well would have benefited them and some kind of higher realizations. And that's why, in fact, you have the EBITDA number that's improved by around 900 rupees on a sequential basis. So a thumbs up out there. In terms of the overseas business, well, in the US business, the plates and the mill business, it reported a positive EBITDA number, while you have the OI operations where the losses did come down by half. So the US business continued to report a mild net loss, though the losses have come down drastically on a sequential basis. So you like that. However, the Italian business, there was the order that got a little bit delayed, and that's why that reported a little bit of a weakish performance. What's good as well is because of their release some working capital, they've generated a good amount of cash. The debt number has come down to around 77,000 crores, which is a reduction on a sequential basis by around 3,000 crores. On the BPSL asset, they believe that they have strong grounds for availing all legal remedies. So we'll have to wait by to see how that pans out. But going by the numbers and an improved performance coming up in the coming quarter, I'm going with green on that one. In fact, we'll be connecting with the management of JSW Steel later on in the show at around 9:40 a.m. Well, let's go across to Vivek now to tell us about how NTPC's numbers were. Vivek?
Well, good morning. NTPC now slightly subdued set as far as Q4 FY25 is concerned. Now, numbers are restated on a year-on-year basis, but consolidated as well as standalone, so a slight miss to the consensus expectations and even to our own poll. But looking at the revenues, largely higher by 4.5% on a year-on-year basis. EBITDA up 4%. Margins coming in quite steady at 29.6%. Profitability up by 24%, largely aided by the strong performance of both the subsidiaries as well as the joint ventures of the company, and this is something that aided the bottom line. Now, talking about the key takeaways from the conference call that the management held over the weekend. Number one, the company has missed the target for commissioning. The company had targeted close to 7 gigawatt of commissioning in FY25, but in line with most of thermal as well as renewable energy peers, the company managed to commission only around 2 gigawatts worth of capacity. Now, however, the company in the call has given a very strong guidance for capacity addition for both FY26 as well as FY27. 11.9 gigawatt of commissioning targeted in FY26. This includes the spillover from FY25 and 9.9, almost 10 gigawatt of capacity addition in FY27. So that is something that should aid. Overall a miss, so expect some red, but the guidance that the company is given should aid the stock performance here on.
All right, Vivek, thank you very much for that. Well, let's talk about Glenmark Pharma, which have been focused on the back of numbers as well. Ekta is here with details. Ekta, morning.
Morning. Well, definitely a miss in terms of Glenmark's numbers this quarter. 3,256 crores is what they've reported in terms of revenue. Margin 17.2%. Street was anticipating close to 19% in terms of margins. And the adjusted profit came above estimates. But if you look at the geographies, that was weak. India was flat on a year-on-year basis. US in terms of dollar terms was down to around $82.4 million versus $91 million year-on-year. Europe did well. It was the only shining star really. It was up 20%. But overall, the companies also missed the FY25 guidance. FY25 revenue guidance was 13.5 to 14,000 crores. They've come in at around 13,300 odd crores. And EBITDA margin guidance of 19%. They've reported 17.6% on an FY25 basis. Their call is at 8:30 a.m. More details there.
Okay, so Glenmark Pharma is going to be in focus as well. Back to Nigel then. Nigel, JK Cement. How does it
JK
look?
Cement's numbers were good, actually. They beat Jefferies' estimates by close to around 9%, and they beat, most brokerages in terms of, what they were expecting. So on the top line, good growth of close to around 15%. And guess what? The sales volumes numbers actually have come in by close to 16%. That itself is very, very positive. The operating profit as well jumped up by close to around 37%, which is telling you that there was a good amount of margin expansion, which should come up for you on the screen. On a sequential basis as well as on a year-on-year basis, it's up to around 21%, which is very, very encouraging. They've got some benefit because of power and fuel costs coming down by close to around 8%. And the PAT number as well has moved up because the finance cost has been more or less subdued. Now, what stands out is the grey volumes, as I said, grey cement volumes, that's up by close to 16%, which means they've outgrown what the industry has done. They've gained market share as well. And remember, all of this is organic growth. So that gets a thumbs up. The grey cement realizations were up by close to 3% on a quarter-on-quarter basis. That means they're doing something right with regard to the mix. And the standalone EBITDA per ton has clocked 1,265 rupees per ton, which is very, very encouraging. So going with green out here, and for JK Cement, what's good is in the last year, they've been in capex mode, yet the debt number hasn't ballooned up. And also on the EBITDA front, they've reported a more or less flattish number on an EBITDA front for FY25. That's much better than all of their peers. So going with green on JK Cement. But back to Ekta to tell us about Narayana Health. Ekta?
Well, good numbers for Narayana. The revenue was up around 18.4% on a year-on-year basis, 10.6% Q-on-Q and Q4. Margins improved to 26.1% versus 25.3% on a year-on-year basis. And the profit growth was around 3%. India was up around 11% year-on-year. India margins also improved for the company this quarter. The Cayman revenue was up around 50% on a year-on-year basis to 379.7 crores. They have expanded operations there and it's finally showing in terms of the P&L. So good going for Narayana.
Okay, all right. And we will, by the way, hear from the management in just a bit from now on the performance and, of course, the outlook going forward. GE Vernova and Jyoti CNC are the next two we want to focus on. Vamakshi is here with details. Vamakshi, morning.
Good morning, Prashant. Let me first start off with GE Vernova. The company reported a largely good set of numbers on the operational front. When you look at the revenue, that saw an uptick of almost 26%. This is slightly lower than what the street was expecting, mainly on account of the growth that we saw in the exports. The gross profit margin for the company improved by 912 basis points. The EBITDA margin came in at 21.9%, the highest seen among HV transformer peers. The net profit too saw a very strong uptick of almost 181% on a year-on-year basis. In fact, the management said that the endeavor is for the company to sustain the gross margins at this level or improve it further. The best is yet to come. As far as ordering activity is concerned, order inflow saw an uptick of almost 125% on a year-on-year basis, coming in at 2,990 odd crores, and the order book also stood quite strong at 12,660 crores. So given the kind of numbers that the company has given, good growth in ordering activity, going with the green for GE Vernova. The next counter I'm focusing on is Jyoti CNC. Good numbers out here as well. Revenue saw an uptick of almost 28%. The EBITDA margin too has improved substantially to 30.9%. This is the highest that we've seen in the last couple of quarters. But the net profit actually saw an uptick of only 9%, and that is because the effective tax rate was much higher as compared to the same quarter last year. Ordering activity, the order intake was rather weak, minus 17%. Order book, although saw a good uptick of almost 26%, but given the kind of numbers the company has posted, going with the green for this counter.
Okay, all right. So two green stocks coming in from Vamakshi over there. Thanks for that. Back to Ekta then. She's very busy this morning. Ekta, Divi's in news as well. What's happening?
Well, they've signed their third long-term supply agreement, so that's a positive. They've signed their long-term manufacturing and supply agreement, which is with a global pharma company to manufacture and supply advanced intermediates. The company said that they're expecting meaningful revenue contribution from this agreement. They're not permitted to disclose the name, but nonetheless, there will be some amount of capex which will be funded by the company itself, by the global manufacturer who they've tied up with. So overall, definitely positive news considering it's the third long-term agreement signed by the company. But remember that the stock is very expensive, trading at around 67 times FY26, 56 times FY27. So maybe that could, maybe cap a little bit of enthusiasm, but nonetheless, positive news.
Okay, all right. Got that, Ekta. Thank you very much. On to Vivek then. Eternal could be news because of certain index changes and flows. And Afcons, I think, is on numbers again. Weak numbers there. Vivek, morning.
Well, good morning. Absolutely right. So first, let's focus on Eternal, or earlier known as Zomato. So in line with what we had anticipated, given the fact that the company had gone ahead and restricted the foreign ownership limit to 49.5%. Both the passive index managers, both FTSE as well as MSCI, have gone ahead and announced weight reduction in the indices for Eternal. So now this particular weight reduction for FTSE will happen on May 27th and is expected to lead to outflows of close to $380 million. The MSCI weight reduction is expected to happen on May 30th, and that is expected to lead to outflows of close to $460 million. Remember, the flow estimates are as per IIFL Capital, but given this particular overhang of passive selling pressure, expect a red on the stock, at least at the open, as far as Eternal is concerned. Now, coming to Afcons Infra, like you mentioned, muted set. First up, if you're looking at the guidance, the company had guided for a flat to marginal growth on the top line. However, for FY25, the company has seen a degrowth of close to 4.5%. But looking at the Q4 numbers themselves, very muted. Revenues lower by close to 11.5%. EBITDA down by almost 17.3%. Margins too compressing almost 60 basis points, and profitability down by 23%. The one solace is the fact that the order book remains quite strong at a little over 36,870 crore, and the order inflow as far as L1 position for the company is too quite steady at over 10,650 crore. Company says that they expect to deliver confident, sustained top-line growth while maintaining a sturdy margin profile. In fact, in an earlier call, the company had expected 20 to 25% top-line growth for FY26, but at this point of time appears to be a steep ask.
All right, Vivek, thank you very much for that. So lots and lots of stocks on the back of numbers to watch out for. Well, just quickly recapping our list of stocks here. So stocks with positive news flow are JSW Steel, JK Cement, Narayana Health, GE Vernova, Jyoti CNC and Divi's Laboratories. Well, stocks with negative news flow are NTPC, Glenmark, Pharma, Eternal and Afcons Infra. All right, well, let's just quickly tell you the most important news flow around commodities as well. Manisha is here as always. Manisha, morning.
Morning, Prashant. Thank you for that. Well, a couple of things which seem to be supporting or a risk on in case of commodities. One is Trump announcing a delay of 50% tariffs on European Union. And the second is the US dollar index coming off its highs and dropping below 99 right now. That seems to have supported the crude oil prices to gain for a second straight day, where it also has to do with the rising geopolitical risks in Middle East. Israel military says that they are planning to capture 75% of Gaza Strip in next 2 months. So these kind of statements clearly has had a premium building up in case of crude oil prices. But the decline in dollar and the China stimulus measures has been supportive for metals. So right now, copper is trading 0.5% on the higher side, and the support also comes in for aluminum and steel prices. The precious metals also have gained. Remember, we saw gold prices gain up 2% on Friday. Gold gained up by 5% in the previous week, and this was the best week in 6 weeks that the gold has put out. So, well, yet again, the tariff concerns, U.S. statements on Apple, Harvard, concerns on high U.S. government debt, sell down in treasuries, and of course, China importing gold at 11-month highs for the month of April has been supportive as well. So even as the U.S. markets are shut today, it's a long weekend there, we are looking at Asian markets starting quite strong when it comes to many of these commodities.
Okay, all right. Thanks a lot for that, Manisha. For the time being, we slip into a short break. On the other side, we have the management of Narayana Health that's going to be detailing their Q4 earnings. Stay with us.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Well, rains are here. It's overcast. It's cloudy. It's actually a beautiful morning. And earlier the better, as they say, especially on Monday mornings like this one. Guys, good morning.
Hi, morning. Absolutely a beautiful monsoon morning, and it's the earliest onset, I believe, in Maharashtra ever on record.
Yeah.
Because they've come in well ahead of expectations, and yeah, I think we've got some visuals. Maybe we'll also put them up. But yeah, hoping that the good times last. Lots to keep us busy in the markets, the tweets, the developments over the weekend.
Well, beautiful weather, but just stay safe out there. And I think we've got a market to deal with. So, Prashant, let's get straight to that.
Absolutely. And, before I go any further, US markets are shut today. There is no US. In that sense, we are going to be sort of trading off the cues which comes our way from everywhere else. But no US in that sense. Cash markets are shut for Memorial Day. So that's point number one. Now, on Friday, and the graphics will start to come up, the Nasdaq was down 1% and the dollar index was down about 1% as well. Actually, there are only two things of consequence which happened on Friday in terms of price action. Equities sold off, there was a bit of a risk off, and the dollar index was down meaningfully as well. And we are now closer to 99 than we are to 100. Otherwise, I mean, yields, oil, everything else was neither here nor there. These were the two clear signals in that sense. Now, I'm just going to focus as we did and as we often do on Monday mornings as we look ahead into the week, just two themes. First is kind of a repetition of what I said exactly Monday last week. Has the good news on tariffs peaked? That is one. Second, will long-end bond yields continue to rise? It's happening in the US, it's happening in Japan, it's happening in the UK as well. Let's just spend a minute each on sort of both these themes. Has the good news on tariffs peaked, right? That's the first one. Now, I think we got the answer. Trump on Friday evening, our time, recommended a 50% tariff on EU as soon as the 1st of June if trade negotiations failed. Now, it's very unlikely that you essentially will have 50% tariffs which actually go into effect at that rate of 50%. But it told us two things. One, the Trump team is very frustrated with the pace at which things are going. And second, tariffs are still the number one go-to tool to try and force the change that the Trump team really wants to get done. Now, after the Trump comment, the Treasury Secretary Scott Bessent came out and said, hope Trump's threat would light a fire under the EU. It's arguable if you want to put it that way, but it did sort of elicit a response. So the EU chief came out and said that Europe, and this was on Sunday, by the way, just yesterday, Europe is ready to advance talks swiftly and decisively. But then she also kind of said that we need at least until the 9th of July. June isn't going to be possible to get a good deal. In her words, she said that we need at least till the 9th of July. And Trump has responded. And he's kind of put out a social media post saying that he's very pleased. He had a call and he's agreed to extend the 50% tariff deadline on EU to the 9th of July. So, 3 tweets, and I think it's pretty clear. I'm not sure if Trump has got what he wanted, but at least he's got their ears, standing and sort of listening intently. So, I hope possibly the pace of tariff negotiations with the EU will pick up. Now, the other piece of news was Trump threatening to impose 25% tariffs on Apple. And then I think he threw in, for good measure, Samsung there as well. If iPhones in the case of Apple were not made in the US, he's sort of spoken about this, that what you sell in the US needs to be made in the US in the context of iPhones. And now he's, of course, backing it up with this threat of 25% tariffs. Now, again, very, very unlikely he actually goes through with this. But it again kind of shows you and takes you back from if you're in the markets. Has the question, I think, has been answered in the positive that perhaps the good news on tariffs, right? I mean, things are going fast, etc. Perhaps that news flow has peaked a little bit. Now, the second point, of course, is will long-end bond yields continue to rise? And here, just a couple of points. There is, of course, as I said, if you look at the US 30-year, which is 5%, north of 5%. If you look at the UK 30-year, you look at the Japanese very long-end bond yields, everything is slowly gathering pace. They're all pushing higher. And looks like, it's a combination of two things, especially in the US, lack of demand for bonds. And the second, of course, is supply. Supply seems to be coming, and more supply is coming if you just look at that bill which was passed, that spending bill which was passed. Question, of course, is will a breakout in yields hurt stocks? It naturally should in terms of valuations, etc. This week will be important to see if buyers really turn up in big numbers because there is $183 billion worth of supply. Auctions are scheduled on Tuesday, Wednesday and Thursday. The Thursday auction will be closely watched because that's a 7-year bond that the Treasury in the US is trying to sell. So these are the two big kind of items, I think, from a global perspective, which will keep us busy, and we'll have to keep this in mind. Now, just to tie in the levels here on the Nifty, we, of course, on Friday came up very, very sharply and recouped many of the losses. Last week was kind of flattish, which was a good outcome because the week before was extremely good. So you had a very good week, and then you had an okay kind of a week, which is absolutely acceptable. Resistance for the Nifty is 25,116. It's not a new level, it's a swing high. Support stands at 24,462. That's on the downside. Nifty Bank also bounced, by the way, almost exactly from the 20-day moving average on Friday. Here the resistance stands at 55,695 and the support stands at about 54,576. Still in a bit of a range. We'll have to see if there is enough in the tank for the market to continue the breakout that we saw on Friday's session. GIFT Nifty will give you a quick sense of how we are likely to start. About 70 points higher on the GIFT Nifty this morning. Surabhi.
Yeah, absolutely. I mean, it's been an absolutely chaotic, I guess, last couple of days, right, with respect to those tweets, because, and the tweets have been not simple and straightforward as well. They never are when it's Mr. Donald Trump. So he starts out by talking about the EU, and that kind of caught the market by surprise. Remember, I mean, US markets obviously ended negative for the week and on Friday as well. He starts out by saying that the EU has been very difficult to deal with. Our discussions with them are going nowhere. And this coupled with the tweet on Apple as well. And that really, the market was not taking too well to that. And then the reversal that's led to a little bit of a relief. By the way, on Friday, the EU market sold off between 1 and 2% because of these tweets. Not just that, auto stocks in the EU on Friday sold off big time. The auto index was down 3% because of this 50% tariff threat. Now it's been pulled back. On Apple as well, I just want to highlight this because it's telling. Why is the market selling off? Because it's telling the language that's being used. He says, I long ago informed Tim Cook of Apple that I expect iPhones will be sold in the US, will be manufactured and built in the US, not in India or any place else. And then he goes on to, of course, give the threat of this 25% tariff. So all of this has been keeping markets on the edge. This morning, the picture across Asia is a little mixed as well. Some markets like Japan are actually doing well. The mainland Chinese market is also up, but Hong Kong is down. So the picture is not uniform is a short point. Nikkei about 0.5% higher, mainland China about 0.25% higher. Hang Seng is slightly lower. On Japan, more trade talk and tariff talk coming through. And it seems that there is progress with the Japanese because the Japanese PM, Ishiba, yesterday was speaking to the press. And he said that he's seeing progress in the trade negotiations with the US. And he's saying Tokyo is aiming to advance the talks with the US. And they're talking about a lot of areas of possible cooperation, including shipbuilding, repairing US warships, trade routes across the Arctic, and so on and so forth. Not just that, the Japanese market is also up because now this whole US Steel, Nippon Steel merger has finally got the Trump administration's blessing. Donald Trump tweeted on this as well, and he said that US Steel is entering a planned partnership. He's no longer calling it an out-and-out sale or merger. And he's saying the headquarters will remain in Pittsburgh. It'll add, XYZ number of jobs to the US, to the US and the economy. So that's been a talking point. Watch out for geopolitics, and the headlines out of Ukraine are not good at all. It's the largest ever drone strike we've seen on record since the war began in 2022. A total of 367 drones as well as missiles, 13 people dead, including 3 children. So very, very troublesome over there. And again, Donald Trump has tweeted on this as well. The reason I'm highlighting is that all of this is, going to be there for the market to digest. He's saying that Putin has gone, quote unquote, absolutely crazy. And that's one tweet that's come in. He's saying he's needlessly killing a lot of people, not just soldiers. Missiles and drones are being shot into cities in Ukraine for no reason whatsoever. Putin has always said that he wants all of Ukraine, not a piece of it. And if that happens, it will lead to the quote-unquote downfall of Russia. Then he goes on to say that Zelensky is not doing his country any favor as well, and it's causing a lot of problems. I don't like it, etc., etc. He ends this particular post by basically blaming the Biden administration. They're saying that this is Zelensky's war, Putin's war, and Biden's war. It's not the Trump administration's war. So anyway, all of that is going to be on the market's radar. Lots and lots of global news flow. Coming to the domestic cues as well, consolidation week all through last week. The bias was negative, but Friday we saw a perk up and the flows on Friday have been positive. So let's just look at the flows. Foreign investors were again net buyers on Friday. They bought cash market equities worth almost 1,800 crores. That was a good point. Domestic institutions also, small net buy figure of about 300 crores coming in. The RBI dividend news, by the way, is out. And as Sapna was indicating to us on Friday, the dividend is not as high as what the street expectations were. It's not over 3 lakh or 3.5 lakh crores. It's a far more modest. 2.69 lakh crore rupees that the government will get. Monsoon progress we have already discussed, so it's good news coming in. It's ahead of schedule, already hit Goa, obviously Kerala and also Maharashtra. Finally, I'll end with some specific, market-specific stocks and news action. There's a lot of IPO buzz today. Watch out for this. Two new issues are opening. Leela Hotels IPO, and these are all the Leela properties, ex of the Mumbai property, which is HLV Ventures. This is a 2,500 crore rupee fresh issue, 1,000 crores of OFS. Could be interesting. There's a large private equity investor that's backing this entity, Leela Hotels. And then there is AG's Vopak Terminals, and this is a fresh issue of 2,800 crores. It's a subsidiary of the listed AG's Logistics. So IPO action will keep us busy. So will legal action. I know Nigel is going to be keeping a very close eye on JSW Steel because aside of the numbers, there are two separate cases. There's one in the Supreme Court and one in the NCLT. As this matter goes, the singles are directing or are pleading that the NCLT should direct the liquidation order that was given by the Supreme Court. JSW Steel is going to the Supreme Court against this, liquidation. So let's see how this plays out. This is a hot story and promises to be fairly lively today as well. Nigel.
Well, for today, the big question is, will the domestic money be strong enough or are they in a great mood to actually take the markets higher? Because we have two big equity markets that are actually shut. The US markets because of Memorial Day and the UK markets as well are shut today because the Spring Bank holiday is what we have out there. So foreign participation could possibly be relatively lower. Can the domestic money push the markets up? Well, we'll know later today. What about the FIs? What did they do in the index futures? Well, they added equivalent amount of longs as well as shorts. They continue to remain net short with close to around 67% of their positions on the short side. And if you look at it in absolute terms, the FIs, they are net short with close to around 50,000 contracts on the short side, while the clients, they are net long with close to around 50,000 contracts on the long side. So both of them at opposite ends, as we've been telling. Moving to the options data, then that's pretty interesting actually out there because there is signs that the call writing is continuing. The 24,900 call, well, that was fairly active in Friday's trading sessions. A good amount of open interest addition out there. The 24,950 call as well, fairly active. On the downside, though, there was some put writing that did creep back in there. So you had the 24,800 put that did see some writing. So these writers, they'll be hoping that the 24,600 odd mark does hold out. But given the kind of call writing that we have seen, I've been talking about this reference point on the upside. 25,125, that's the important resistance mark. The bears will want to defend that particular mark. But what was encouraging in Friday's trading session is, for the last 6 trading sessions, we were making lower highs. However, that trend broke because in Friday's trading session, we made a higher high after quite a few trading sessions, which is encouraging. Which brings us to the levels. As I mentioned, the high that you're looking at is at around, you want to break this mark, 25,150. That's a resistance level. On the downside, last week's low becomes a bit of a resistance mark. You have the 20 DMA as well in this vicinity. For the Nifty Bank, the important mark is around this 56,000 odd mark. In the last 45 days or so, we have gone there numerous times, but we've not been able to conquer that. The fresh leg for the market moving up starts once we decisively conquer this mark. Stocks that I'm looking at is we have Trump's tweets with regard to UK and the duty is out there. It seems he's going a little bit easy for now. Normally we see that, Tata Motors is a stock that normally reacts to there because you have the Defender, the Discovery, both of them, they are, they're manufactured in EU itself. So I'll keep an eye out on Tata Motors because of what Trump had to say with regard to the EU. So that's a stock to track for the day.
All right, Nigel, thanks very much for that. So that's the setup as we see it. We have William Lee, Chief Economist and Executive Director at the Milken Institute, who is joining us now. William, good to have you with us here on the program. This back and forth with the EU, William, how do you see it? Will it follow the typical thing we've seen, a very high rate threatened, a lower rate, which is then walked back to a low rate and then something in between, and the market cheers because it's not as bad as what markets thought it would be, but it is higher than what it was before. What is your sense, William?
Well, if you look at the pattern of negotiations that have gone on up until now, you found that the partners with the U.S., those are the countries that really want to partner with the U.S., invest in the U.S. and produce in the U.S., like the U.K., Japan, they were received in a very friendly way. Even when there are some complaints about the speed of the negotiations, how they are getting stalled, they really were making steady progress. And then you had competitors like China, and even there, China says, well, we produce stuff so well, we don't want to produce in the U.S., and we're going to import it into the U.S., and we're going to pay these tariff barriers. And even there, you find that the type of barriers you're going to be facing are really quite limited. The minimum 10% tariffs and the fentanyl tariffs, which is a very special case. But now we have the EU. And the EU, I think, came up with an initial offer of, oh, let's go 0-0 tariffs. And of course, that's a joke because the GATT rounds and the rounds of tariff reductions we've had over the decades have reduced tariffs to almost nothing. And the real obstacle to trading with the EU has always been the non-tariff barriers. And the Europeans are masters at coming up with all sorts of legal and bureaucratic ways of keeping people out of their market and protecting their domestic giants. Now, you notice the EU has no tech industry. The EU has no source of real technological innovation of the sort that we see in Asia and of the sort that we have seen in the United States. So in some ways, the EU is just expressing to us the fact that they just are not willing to adjust their regulatory structures and their bureaucratic structures in a way that would be compatible with the kind of innovative investments that we really need for the 21st century high-tech industries. So that tells you something about the nature of the EU market. And I think the negotiations with them will continue to be very, very difficult because they really are very resistant to the kind of progress that a lot of the Asian and American companies really want to see.
William, morning. Thanks for joining in. The other development, I mean, I wonder how you read that. This whole directive, and it's a straight diktat to a publicly traded company, right? I'm talking about Apple, saying you don't make here, you have to make here. I mean, this reminds us of the license Raj era back in India, back in the 70s, and we've come a long way from there. The Apple stock was down 3%. But could this snowball into something bigger, or do you think the market will just ignore it and move on?
I think it's going to be something like what happened with the U.S. Steel and Nippon Steel merger. Donald Trump said, look, you can merge with any other company you want, but come on, this is such an iconic company, U.S. Steel. They reached an agreement where they just have massive amounts of Japanese investments. There's a lot of co-ownership, but it's not called a merger. I think Apple is such an iconic symbol of the tech industry for the United States. There again, it's going to have to be a very special kind of a deal. I think that's not representative of the other tech industries and other tech companies like NVIDIA that's making deals left and right. And I think those are the more representative type of deals that you'll see in the marketplace that the Trump administration is favoring. And Apple really is going to be like Nippon Steel, U.S. Steel. It's going to have to be a special carve out where Tim Cook is going to have to show we're serious about producing in the United States, not just a couple of MacBooks. And he's going to have to come up with some way of demonstrating his seriousness about moving high-tech industries and high-tech jobs into the United States, which is really the message of this administration.
All right. Hi, William. Good morning. Good to see you, Ben. Let's focus on the emerging markets. And India is, the question that I want to pose to you. How do you see things panning out here as an equity market? Well, we've got a little bit more expensive than the last time we chatted. But what's the outlook from here on? India, the longer-term growth story, while China, well, that's a more of a tactical play. Your take?
The Indian partnership, I think, is going to be a very special one. I think the Trump administration and certainly the Vice President Vance has made it very clear that the United States wants to treat India in a very special way. India, in some ways, is one of the few countries that trades with everybody, right? You're trading with the Russians, you're trading with the Chinese, you're buying also oil and all sorts of materials from all over the place. But because India is such an important producer and such an important alternative to China, it will be treated very, very differently. And I think we'll see that progress. For other emerging markets, I have to remind you again of the Lucas paradox. Lucas paradox, the Nobel laureate of University of Chicago said, money flows from where capital is least abundant to where it's most abundant, because in the advanced economies where capital is most abundant, it's also where capital is used most productively. That's where the innovations are. That's where the highest returns are. So in many ways, there may be a lot of portfolio readjustments and people wanting to diversify into emerging markets, but on net, we still see a net capital flow into the advanced economies from emerging markets. And in a way, that's unfortunate, but also it allows the emerging markets to really specialize more in the kind of industries in which it has a comparative advantage, rather than trying to leapfrog into these very, very high-tech, capital-intensive industries. But India, as I said, I think it's going to be a very special case where I think India is going to be allowed to do everything. And I think most investors are investing in India, not just as an emerging market, but perhaps as the one emerging market that's going to leapfrog all the others.
Okay, well, we surely hope that happens, William. Thank you very much for your perspective. Appreciate your time and look forward to a longer chat next time around. Thank you for joining in.
All right, well, time to slip into a short break. We've got a lot of stock-specific action to track for you. Get to that in just a bit in our special Top 10 segment, but I'll run you through the list. We're looking at JSW Steel, JK Cement, Narayana Health, GE Vernova, Jyoti CNC. They'll be reacting to positive news flow. As add to the list, Divi's Laboratory as well, but not what's going to be reacting negatively to the news flow will be NTPC, Glenmark, Eternal, as well as Afcons Infra. We'll keep an eye out on all of these names.
Welcome back. Let's get to some corporate conversations then. Lots and lots of companies have been reporting numbers over the last couple of days, and Narayana Health is the first one that we're speaking with this morning. Now, Narayana reported a strong set of numbers for the fourth quarter. Revenue and margins came in healthy. Growth was driven by higher domestic volumes and better realizations as well. We have Sandhya J, Group CFO at Narayana, joining in for some perspective on how this year looks like. Sandhya, thank you very much for joining in, and congratulations on what's been a good quarter for you. I think both India as well as the Cayman facility, which is up and running, they've all been firing for you quite well. So let's just break this down. I mean, if you could tell us how much of the growth was driven by higher volumes, I mean, to what extent have you seen volumes rise in the fourth quarter? And how much is pricing led? And again, some indication of where these two trajectories will be as we look at the start of this year.
Good morning. Thank you for having me here. So for this year, like every year, our pricing has two parts. One is the price increase per se, which we have taken on 1st of January. We take a low single-digit price increase. So some of the growth has come from price increase, but a large part of the growth has come from realization. That is better payer mix, better, more high-value procedures, and volume increase as well. On the volume side, the domestic volumes have been quite healthy, like we've reported out. We did have a significant impact on Bangladesh. So if you look at quarter four alone, Bangladesh was a year-on-year 53% decline, whereas the domestic volumes have been very healthy, upwards of 15%, and that's kind of given us the balance in terms of performance.
Okay. The average revenue per patient apparently is up 13%. I think year-on-year it's up 13%, 9% quarter-on-quarter. Can you give us some sense of occupancies as well, and where you are expecting these metrics to stabilize, say by halfway down this year?
Sure. So our occupancies normally range in between 60 to 65%, and I think that is where we will be, because we don't look at occupancy as the key measure, but more throughput. And you would see that we have not added any bed in the past several years, but you've seen improvement across all our parameters, whether it is our margin performance or our ARPP, ALOS, and all of it is coming because the focus is more on throughput. So from an occupancy point of view, we are not guiding anything different. In terms of ARPP per se, the price increase driven ARPP will be small because we have taken a small price increase. We will continue to show growth like we have shown in the past, driven by higher realization procedures and driven by payer mix optimization.
Okay. Margins, I mean, so is 25% a very stable level that you're at, and do you think it'll be here? Or could you actually see improvement this year in the EBITDA margin?
As far as the India margins are concerned, Q4 we finished 21.5%, and as a goal, we do want to continue to expand on the India margin side. So you will definitely see improvement in the India margin going into FY26 also. Cayman will probably stabilize at this level.
At 25%?
Overall, at a group level is 25%, yes.
Okay. So we should expect some stability there. Just a word on the new hospitals, the one in Gurugram, there's one in Dharamshala. What is it that you're expecting there in terms of break-even timelines, throughput levels, as you call it? Just some guidance out there, and whether and some sense of capex that you might be incurring this year also. Just give us a sense of the cash levels in the company and the capex this year. Will it be lower because you've already been, you've launched several new facilities already last year?
From a Gurugram and Dharamshila performance point of view, Dharamshila has broken even. It delivers a reasonably healthy EBITDA. Gurugram has had broken even in Q4. And we are hoping that we will be able to start generating positive EBITDA in Gurugram in FY26. As far as our capacity is concerned, we have added capacity only in Cayman in FY25, and we have announced a large capex plan for the next 4 years. So we have already announced about 2,000 beds at an outlay of 3,000 crores for India, and we are looking at more opportunities. So a large part of those spends will come over the next 3 years. The land acquisitions have happened for many of those investments. So almost 20% of this outlay is already spent because of the land investments we have done. And then the build out will happen. As far as Cayman is concerned, there I agree with you. We have completed our capex, and you will see very, very small maintenance capex in Cayman. But there the capex outlay is completed.
So the total outlay is 3,000 crores over 3 years,
yes,
to add 2,000 beds, right?
Yes, at the moment, yes.
Okay. And how much of that will be incurred in FY26? And against that, what is the cash level? What is the existing debt level?
So our current debt, net debt to EBITDA is 0.15, so which means we're very, very healthy in terms of debt. And we are also holding a high cash balance as a group. So therefore, we will, at the moment for the current year, I don't think we will reach our aspirational net debt to EBITDA of 2. We aspire to stay under it through the capex period, but if there are some periods where we have a very good opportunity that we need to go after, we may temporarily breach that limit. But at the moment, we are looking to stay under a net debt to EBITDA of 2.
Okay. All right, Sandhya, thank you very much. Lots of details there. Quite helpful. Thank you for joining in, and good luck with the rest of the year as well.
Thank you. Thank you for having me here.
Okay, all right. That's Narayana Health at the end of the fourth quarter. Let's move on and welcome in Prakash Diwan to talk about individual stock ideas, fundamentals as well. Prakash, good morning and happy Monday to you. Since I was just talking with Narayana, let's start there. The healthcare space, hospitals, healthcare. Any interest? Do you like any of the stocks, whether it's Narayana or maybe the larger players like Apollo?
Good morning, Surabhi. No, lots of interest in Narayana itself. And NH has been one of my favorites within this so-called crowded space. And what I love about their business is the uniqueness of the business model. While it's been expanding in terms of not just being asset light, it's actually in a way where they have amazing pricing power. They started with very low price points, started moving into higher end realizations, so throughputs. And remember, the percentage of robotic surgery is going so majorly, it's moving up, and that's very high margin. So if that were to kind of continue galloping the way it is, you'll probably still see some improvement happen in the quarters to come. So absolutely right. And this has bucked the trend. You look at whatever happened to the rest of the market, this was still making 52-week highs. We spoke about it at about 11-1200 just about less than a year back, and look where it is today. So I think it's something which you should look at seriously if you have allocations deemed for the sector. The rest of the companies in the same space are struggling because of very high capex. Their ROCs are still kind of not as robust. So great franchise, great business model, and great financial metrics. So very, very positive with this.
Okay, all right. Hi, Prakash. Good morning. Let's talk about a couple of these nifty companies that came out with a set of numbers. JSW Steel, the numbers look pretty okay, actually. Good improvement in the EBITDA per ton on a sequential basis. And what's encouraging is they've got some benefit of lower coking coal costs in the past quarter. They'll get another $10 fillip in the coming quarter. And they'll also get a price increase of around 2.5 to around 3,000 rupees per ton, which will make the EBITDA per ton look even better from here on. Your view?
Oh, absolutely, Nigel. Good morning. So it's a company that doesn't make staple steel or regular steel from 100% of its capacities. I think it has the advantage of making special steel as well, and specialized steel is something which will start continually seeing a lot of offtake given how some of the infrastructure growth is happening around. And remember, the global setup is just getting to be much more positive for metals and even steel. It's not restricted to just copper and aluminium. And if the EU is going to struggle to be able to kind of set tariffs, in a favorable band with the US, given whatever is happening, though we've seen an extension and all those. But I think a lot of steel making from India will start kind of making significant strides from a global context as well. So, and then some of these companies like Tata Steel, JSW are now fairly well diversified in terms of geographies as well. So you will have some advantages that roll in. So I'm quite positive. In fact, it's a very decent set of numbers given how things could have been on such a large balance sheet. So they managed to kind of pull it off. And I think it also sets the tone for this continuation of improvement to happen. So with this, without any dramatic price hikes and with any dramatic increase in the market demand for some of this special steel. So fairly a moderate quarter with still, that's where the advantage is. The correction that you saw in the steel companies, Nigel, that's in fact the advantage that you had to kind of get in, because this is a sector, once it takes off, it at least does well for about 18 months. So, these numbers tell you that it could probably be good times for most of the steel players, and this could lead that improvement from here.
Okay, all right. What about cement, Prakash? You got JK Cement. The stock is not particularly cheap. It's very close to its 52-week high. The numbers were good. The EBITDA per ton has improved. The net debt, they've kept it more or less at a stable number. And they're already talking about capacity moving to around 30 million tons, which they've already laid out a fixed plan out there. What's your view on JK Cement? And also, I wanted to ask you about the other one that's not very cheap is Ramco Cement. The numbers are disappointing. You had a big fund coming in there and buying a few lakh shares at around 1,000 rupees per share. And that's why Ramco, from standing in the red, in fact, went in the green. What's your pick from the pack?
So, no, you're right. JK comes expensive for sure. And I think it's more because the market's looking at what's in store for them. Their commentary has been fairly positive. And, they've probably taken a leaf from the Shree Cement copybook. I mean, keep growing organically without much of debt increase. And that kind of starts paying off. It takes a little bit of time in terms of, execution, all your expansion. But they have access to raw material. They have something which they can do in terms of, a lot of the places that JK is prevalent in. They have access to the backward integration possibility. So I don't see any reason why they will not be able to implement this. And if this is being done with such a low leverage, it's great. Ramco, I don't know. It's probably a bit of that float issue. A lot of buying that comes through, large buying on a particular day, and things look very differently. But the numbers, as you said, are not definitely very encouraging. Out of the pack, over the last few months, what I've noticed is that the larger players have actually started turning out to be much more dependable if you were to make some allocation as the sector starts re-rating itself. There have been some price hikes. You'll probably see much more concerted, east and southern markets kind of rev up. But Shree Cement is something which I want to point out. It's something which has done exceedingly well. It's usually expensive to buy, but it's worth paying that premium because it probably keep improving year on without any blips. So, and then of course you have the ACCs, Abujas of the world to choose out of. But I would believe it. I would stick with the larger ones this time and not those small Dalmia, Bharat, Sagar. And all. There's a lot of activity that was around built around those names. But I think now the focus is going to be on sheer market growth, volume growth, and that's where the larger ones would probably be better off.
Okay, all right. So stick with the big boys. That seems to be the call. Prakash, got it. Thanks very much. Shorter chat today because of lots and lots of earnings,
Yes,
but we'll
no
connect
worries.
again soon. Thank you very much for joining in. Need to take a quick break. On the other side, we have our technical experts joining in. Sudarshan Sukhani joins in with some thoughts and ideas, and we'll be back. We'll have the pre-open as well in just a bit.
Welcome back. Hope you're having a good morning. As promised, let's get straight to our technical expert. Sudarshan Sukhani joins us on the show. Hi, Sudarshan. Good morning. Good to see you in. It's a beautiful rainy day here in Mumbai. But what's your sense with regard to the markets? We had a good trading session on Friday, actually. We continue to remain on the range. The levels you're looking at and the trade on the Nifty.
Good morning. Well, it could be raining in Mumbai, but it's a very dusty, stormy day in Delhi. And you must have read news that, Delhi, once we have 15 minutes of rain, the whole city gets inundated. Well, that's different.
Stay safe, Sudarshan.
I'm sorry?
Stay safe.
Yes. Now, the markets are cheerful. Last week, we had a lot of volatility, and that volatility has ended with the Nifty actually finding support. Now, the support levels had broken down. They bounced back. All that is part of that process where the market is finding its feet. But on Friday, I had suggested that we should be long, and that view continues. See, that doesn't mean we won't see volatility. We could easily see wide, sort of unknown swings. But the broad theme is that the Nifty should slowly inch upward. And I think that this time, this week, and maybe this week and next week, we will see significantly better momentum on the upside. So if you are long, stay long. If you're not long, look for every dip to go long. Your stops, your exit levels are 24,600, below which you say, okay, it didn't work out.
Got that. Sudarshan, morning. In terms of specific trades, what would you have?
Well, I have a lot of buy ideas and one short sell. I'll start with the short sell. Coromandel is an intraday short with a stop above 24.30. ITC is a buy, and that is happening because of a lot of these FMCG companies are now coming in the buy list. ITC is just the latest one. Buy with a stop under 430. Bajaj Finserv is a buying opportunity. I've been favoring NBFCs and banks, essentially the financial space, and this is part of that. It's a buy Bajaj Finserv with a stop under 2,000. And SBI Life is my fourth and last buying opportunity. Or rather opportunity, buy SBI Life with a stop under 1760. 3 buys, 1 sell, focus on the buys.
Okay, all right. Thanks a lot for that, Sudarshan. Well, for the time being, though, we'll slip into a short break. On the other side, we'll get chatting with the management of Ashok Leyland. Stay tuned for that conversation.
Okay, welcome back. There's about 14 seconds to go for the 14 minutes to go, beg your pardon, for the market open. The pre-open, though, is just a couple of seconds out, and we'll have the rate starting to appear in just a bit. Now, Ashok Leyland reported a good set of fourth quarter numbers. Profits were boosted by tax revenue. Total volumes were up 5% on a year-on-year basis. We are now joined by Shenu Agarwal, MD and CEO at the company, to take some questions. Mr. Agarwal, great to have you with us here as always on CNBC-TV18. Now, fourth quarter was, as expectedly, strong for you. But over FY26, estimates from most auto bodies are not reflecting a bright picture. What would be your estimates for CV industry for this coming financial year, this financial year?
Oh, actually, then I would have to say that our view is very different, because we are very optimistic about FY26. Especially if you look at the momentum that was created in Q4 of FY25, where with the CV industry, the medium and heavy duty industry, grew by about 4%. I think that's a signal of the times to come, right? So overall on FY26 basis, we think there are a lot of factors that are going to move in the positive direction. The interest rates have already come down a little bit, and there is a hope that they will further come down in future. The macroeconomic activity also is in our favor, especially some of the sectors like steel, mining, etc. are going to really grow this year. Also, we are seeing that replacement demand should start showing up this year, because we are sitting at the high, all-time high aging of the fleets, right? So monsoon prediction is also very, very good this year, right? So I think there are a lot of factors which are going to drive the growth in the industry. FY25, you would recall that Q1 had actually a 10% growth, right? So in Q1, we are sitting on a slightly higher base, and therefore you wouldn't see maybe that much of a growth in Q1 this year. But from Q2 onwards, and last year Q2, I would remind you that last year Q2 had actually degrown just because of the slowdown of the capex in the government and some effects of the erratic monsoon, right? So I think from Q2 onwards, we see a lot of optimism in the way the industry would behave, and therefore overall on FY26 basis, we continue to be positive.
All right, Mr. Agarwal, good to hear then that you're going to be positive. But do you expect FY26 to be better than FY25 for the entire CV industry? And what would the growth expectations be for the industry?
Listen, it would be different in different segments, right? So I think buses would definitely continue to grow. In the medium and heavy duty segment, especially in some of the segments like tractors and tippers, we think there would be fantastic growth in the industry. But overall, if you say, I would say MHCV should grow in kind of mid-single digits in FY26. But the overall CV industry, including LCV, etc., I am really hoping that it would cross its earlier peak of FY19. And it should cross that 1 million mark that we had been waiting for a few years now.
Mr. Agarwal, morning, sir. Let's also talk about margins and profitability, right? Because in the fourth quarter, you have seen your margin coming towards your midterm target range of around 15%. But overall, for the year in FY25, your margin at 13% was still below your own aspirational trend line. So can we expect margins this year in FY26 to get to that level of 15%?
We would continue to focus on EBITDA margins, and we will continue to increase on year. It still may take us 2 to 3 years to reach that mid-teen EBITDA objective, but I think we are like very much there. At least if not in numbers, because we are still at 12.7, but at least in our path, in our journey, you could clearly see that in last 3 years, we have moved from 4.1 to 12.7. And we would definitely like to continue on that journey. Now, see, our levers are going to be same, right? I mean, what we have used for last couple of years. So we are working on these 3 levers. Number 1 lever is what you said, premiumization, which basically means generating or garnering ability for us to have a higher revenue per vehicle. Right? So that can be done only if we offer extra value to our customers. So customers are happily paying more to us. Right? In that sense, we have really worked on a lot of initiatives on the product and technology side. Many of these are already in the market, and many of these you will see that will come to the market over next 1 year or so, right? So that is one part. The second lever is the lever of cost. You know that Ashok Leyland is a cost leader. Our cost per vehicle is the lowest in the industry, and we think it is a great strength, and we don't want to lose on it. Rather, we want to build strength over strength as far as cost is concerned, right? Therefore, even after 3 years of successive good cost savings, both in material and non-material cost, we would continue on that journey, even in FY26. And we still think there is a lot of potential for us available to further reduce our material cost and also some other costs. And the third lever is the lever of after sales service. We told you last time that we are embarking on a journey or a project we have started within Ashok Leyland, where we want to target delivery of best-in-class service to our customers after the sales, right? So that project is already in action. You will start seeing results over a period of time, but the focus or the strategy is the same. So premiumization, cost leadership, and best-in-class service.
Mr. Agarwal, how is the commodity trend looking in Q1 of FY26 after almost a flat quarter, which we saw in Q4? the quarter for which you've reported numbers?
Yeah, there are some challenges emerging, as far as commodity costs are concerned, especially on the steel side. The government, as you would be aware, they announced a safeguard duty on steel, which has resulted in some increase in the cost, right? And steel being 60% of the commodity that we use in a truck or a bus, it has a significant impact on our cost structure. So there would be some challenges that we will see in quarter one, right? But we do believe that this is a temporary phase. Even that safeguard duty that government had announced is only for 200 days, right? So we will see starting Q2, sometime in Q2 or early Q3, we will see it neutralizing back to its original position, right? In any case, some other commodities like rubber, which is also a significant cost to our industry, is actually it is getting softer a little bit. Last year, rubber had increased by about 7 to 8%, but now it is getting back to its original levels, right? So there is a mix, although there is a concern about steel, but some other commodities, will help in the favorable manner. Also, our internal actions on cost savings, etc., are continuing, right? So we do believe that we should be able to neutralize it, although there would be a little bit of pressure in Q1 maybe. But I think from Q2 or Q3, this whole thing should be behind us.
Okay, all right, got that point. Finally, sir, what's the update on the Hinduja Leyland Finance IPO? Are we going to see it in this year, first quarter?
You are right. I mean, we were really expecting it to list by Q1 FY26, but unfortunately, some of these approvals are still pending. Some of them we have received, but a few are still awaited. Now, every time we give you a call because, give you a timeline, hoping that these will come, but these are not necessarily in our control, right? But at this point in time, we are again very hopeful that these approvals should come within the next few weeks. And therefore, after that, it will not take us more than 2 months to list the company. Right, so I know we are slightly delayed on that estimate of Q1, but things are progressing well, right? So it will happen very soon. We'll give you more news when we have the results.
All right, Mr. Agarwal, we'll leave it there. Good luck as you continue to navigate, the changing environment. But of course, intrinsically, much more optimistic estimates and the way of looking at the industry growth as compared to some of these industry bodies, etc., which we started by citing. Thank you again. Well, Gautam Trivedi is now joining us. He's managing partner at Napier Capital LLP. Gautam, great to have you with us here on the program as always. And you're back from the US. You've been back. You were attending the Berkshire AGM. You attended the Berkshire AGM, but then, of course, spent some time meeting global asset allocators, investors, etc. there.
Yeah.
So the question really is about the feedback that you got with regards to flows into India, which has been strong. Foreign flows have been strong over the last month and a half or so. Is it likely to continue? What is the mood like?
The mood actually at the margin is starting to get a lot more positive than when I first met a bunch of people in New York when I first arrived. And then I was in New York right at the beginning and at the end of the trip. And I think the mood within that 2.5-week period itself actually underwent a pretty significant change. The good news was that the India-Pakistan conflict really was not on anybody's radar. People, of course, were aware of it, but the fact is the local media didn't report that much of it. More importantly, it got overshadowed by a bunch of domestic news. The US to China tariff wars that was still ongoing at the time, and other local issues really were more important. So as a result, I think the positivity on India, I think pretty much continues. Now, with respect specifically to your question on flows, and are we going to see significantly more money coming in? Well, the fact is, we did have a dip within the first quarter in terms of the absolute Nifty 50 and the market as a whole. The good news at the time was that that correction led to India becoming a little bit more reasonable from a valuation perspective. But again, it's climbed back up. So unfortunately, we're not cheap anymore. We were cheap briefly, but we're not that cheap anymore. But I see money coming back into emerging markets for sure. So if I look at one statistic, and that's an important one, foreign ownership of the US equity markets is at a record high of 18%. And given the weakness in the dollar that we're starting to see, I think money is starting to flow out. The first stop usually is Europe, so it's not as if it's all coming to EMs. But increasingly, I'm hearing of allocations coming to EMs, and of course, you will see some of that overflow coming into India.
Yeah, Gautam, hi, great to have you on, and I'm glad you brought that up because that was exactly on my mind. Flows coming into India is one thing, but the other part is what's the sense you picked up speaking to all these people in the US about the US market itself? Because look at the tweet storm, right? I mean, every weekend, every other day.
Yeah.
And I just keep going back to the Apple story as an example. It's not just about, whether the Apple stock is going up or not, but it's the administration today, picking up the phone and telling a listed large public traded company what to do and what not to do. So I don't know, what is the overall sense on US equities, and will there be a greater outflow away from US assets, whether it's bonds or equities? What's the sense you got on that?
Yeah, so it's a good thing you brought up the subject on bonds. And one thing that was clearly evident from the 3 weeks that I was there, that inflation is completely raging. I mean, it is literally out of control. Whether it's eating out, whether it's hotels, everything was sold out. And I'm not just talking of New York City because that's a little deceiving because the rest of America doesn't necessarily mean that what's happening in New York is happening in the rest of the US. But the reality is that we went off to a few national parks like Yellowstone. Hotels are sold out. And this is even when we were 3 weeks ahead of the tourist season actually beginning. So travel is booming. We took 8 flights in the 3 weeks that we were there. Every flight, there was not one seat left. So this Memorial Day weekend, which is ongoing right now in the States, AAA estimates that 45 million Americans will travel 50 miles or more from their home. So that itself is a record high. So I think if you look at overall, I don't see the ability of the Fed to actually cut rates. I mean, that's my personal view, and that's some of the view that was shared by the people that I met. I think that the feedback that's coming in, if you look at the first quarter numbers of the S&P 500, they were blowout. So first quarter net income growth for the S&P 500 was as high as...
We'll just come back to that point, Gautam, just a second, to whether the economy is continuing to boom or not. Just allow us, I think 20 seconds, I think we're getting into market opening, and the pre-open suggests about 60 points up to begin with at
60
least.
60 points, 200 points in the sensex, and it's looking like a good open. We'll have to pick it up from there. So lots of stocks to track, and we'll look at indices as we always do, and then we get down to individual names. About 0.25% higher on the Nifty, 24,900. The Nifty Bank is up about 1/3%, 55,600. The Sensex is up about 0.4. Small cap index is up 0.8, and I think the mid cap index will come up on your screen as well, which is up about 300 points there, 0.5% or so. So this is a good-looking start to a fresh new week, and nothing to complain. Almost 25,000, by the way, on the index at this point in time after Friday's bumper turnaround. After a couple of sluggish sessions last week, Friday turned it around. And this morning, it looks like there is continuation. So just 3 names on the Nifty are lower. One of them is Indocin. Eternal, of course, we highlighted as well. And everything else is starting up in the green. Surabhi.
Okay, up and about. But I must point out the result casualty of the morning is Balakrishna Industries. Look at that stock. It's starting 10% lower. And we'll talk more about the earnings hits and misses in just a bit because it's been a slew of mid-cap earnings. But that is a nasty-looking cut on Balakrishna. Anyway, on the large-cap screen, 130 points higher on the Nifty. That's what we've got. And M&M is in leadership position, 1.5% higher. Power Grid, NTPC looking good. NTPC, despite lackluster fourth quarter numbers, still looking quite okay this morning, 1.5% up. ICICI Bank, Ultratech Cement, Hindalco, Tata Motors, Nestle, ONGCs across the board, Trent, Titan. You get the drift. It's cutting across sectors and most pockets are looking strong. Banks are definitely helping the Nifty's case because the Bank Nifty is chugging along at an even better pace, 0.6% higher on the Bank Nifty. SBI, for instance, Axis Bank, all these names are on the upside. In fact, there are only 2 stocks that are negative on the Nifty. One is Eternal, and that's a flows issue because the index providers, FTSE and MSCI, have lowered their weighting on Eternal. That stock is down 3.5%. Other than that, everything is positive on the Nifty. 160 points and 25,000 on the board. Nice.
Well, that's right. Just take a look at a few stocks though that are bursting away from the broader markets. GE Vernova. The revenue was a little bit subdued, but margins at around 21.9%. That's the highest among the high voltage transformer peers. And that's why that stock is locked up. I think it's up close to around 10% as we speak with pending buy orders. So big move is what we're seeing on GE Vernova. So big one out there. Kolte Patil, another one that came out with a good set of numbers. So that stock as well is flying away. Large volumes, Kolte Patil is up close to around 8%. Transrail Lighting, revenues grew by 40%, EBITDA went up by 41%. They reported the highest ever revenue, EBITDA, PBT, PAT in the history. So that's great news. And they've got a good, healthy order book as well, which will serve them in good stead. So explains why that is up 5.5%. Keep in mind, the stock ran up a good deal, ahead of its numbers, but yet it's higher. A few more stocks that deserve a special mention that are moving up in trade. You have Reliance Power. Actually, the first tick was quite good on rather large volumes. So that one should come up for you on the screen. Let's see what it's doing. Reliance Infra, actually, the numbers were quite good. I don't know what that stock is doing because it already had a big run up, in anticipation of those numbers. So big move is what we saw on that one. Reliance Power is up close to around 4% on large volumes. Reliance Infra actually has come in for some profit taking. And JK Cement, pull up that stock. It's up close to around 5%. I told you the numbers were very, very good. We'll wait for the management commentary as well on the con call later today. But otherwise, the street likes it. Up close to around 5% on that one. So good looking screen. Nifty up 150 points. Nifty Bank moving to that crucial 56,000 odd mark. That's the resistance zone. We'll have to keep an eye on that. Advanced decline ratio firmly in favor of the number of stocks advancing.
Absolutely. And, it's looking strong, very, very strong across the board. Just a few other names before we go back to Gautam. You got R Power. Basically, the ADAG, Reliance Power and Reliance Infra were the number one, number two volume-led gainers on Friday. And R Power is back there, 2.5%. It's got humongous volumes for this point in the day. Already. I think we highlighted Divi's. Transrail also is up 7%, 611 on Transrail, again, on the back of numbers which came through. There is Emcure, which again reported numbers, and I think have this management later with us today. Emcure is up another 8%. It's moved from about 1,070 to $1,400 in basically 2.5 days. I mean, today being the third day. So tremendous gains. Shilpa Medicare is coming up with about a 6% pop. And it's got volumes behind it as well. You just heard from the Narayana management. Narayana is up 4%. Stocks at about 1,800. Narayana Hrudayalaya. NetWeb has been having a pretty decent last few sessions. 3.5 here. 1,862 on NetWeb. We had Nilesh Shah, by the way, of Envision, who was talking about NetWeb as something he likes on the Editors Roundtable on Friday. Phenolics Pipe, ITD Cementation, Shakti Pumps is coming up with a 6% pop. It's got decent sized volumes as well at this point in time. So, yeah, I mean, there is a lot happening with regards to specific names that you want to look at. Premier Explosives is down about 7%. So that is coming off the high 3 days back was 621. Stocks at $500 now. So it's given up over 100 rupees very, very quickly. But it had an explosive move on the way higher. And HBL Power, HBL Energy basically is down about 4% as well. They do battery systems, etc. A bunch of businesses, 553 or so on HBL. Honasa is the other one on Friday, which had a rocket move, which is giving back about 4% of that move right now. So that's basically the broader markets in focus. 170 points higher on the Nifty. So it's a good start. Surabhi.
Yeah, I just want to add one more stock, Dreamfolks. Bad numbers for the fourth quarter. It's down about 7%. Dreamfolks down about 7%. The other one is GNFC, which had very good numbers. So GNFC is up about 7%, 6-7%. So lots and lots of individual stocks that are moving around today on the back of news flow or on the back of earnings. Okay, let's go back to the conversation with Gautam. Gautam, sorry, we just ran into market opening there, but if you could just complete the point. So from whatever you're describing, it seems as of now the US economy on ground is definitely booming. So I go back to that question. So US equities and bonds, does the money stay or will it keep looking for other homes? And then we hope one of those homes will be India.
Yeah, I think let me complete the point I was making with respect to the S&P 500's net earnings. So the first quarter net earnings grew as much as 12%. Now on the Max 7, well, I would say Max 6 because NVIDIA reports on Wednesday, the 28th. So the Max 6 have reported an average earnings growth of 28%. And the other 493 stocks have actually grown by as much as 9%. So that's exceeded consensus earnings estimates by as high as 16%. So that tells you that the domestic equity market is still going very strong. There are no significant signs as yet of it slowing down. But like I said, any weakness in the dollar will prompt money shifting out of the United States and going offshore. So hopefully we should get a slug of that. And we've seen some of that come through, about $5.5 to $6 billion since the lows in April. So I think there is more momentum for money, valuations notwithstanding.
Okay, all right. Hi, Gautam. Good morning. Good to hear your thoughts as always. Gautam, what's the top theme that you have, as we speak? Because the headline index, it was a little cheapish, but we've had a good 15% run from the recent lows. The pockets of the market still are very interesting, and there are longer runway out there. I think power is something that you liked. Some of those EMS companies in the past we have spoken about as well. What's the one top theme that you could share with us?
I think power remains a multi-decadal theme in India, and it's not just driven by domestic power consumption, i.e., electricity and lighting up homes, lighting up, factories. Also by the fact that at the advent of AI, and I think I may have said this in the past, but a simple Google search, if it takes 1 unit of power consumption, an AI search takes 10x that. So you are invariably going to see a situation in a country like ours where we have 750 million smartphones. Everyone now knows, has an account with OpenAI or with Perplexity or any of the other AI models. So I think consumption of that will significantly go up, or power will significantly go up. The other element that's going to cause the need for power is data centers. And the Indian government is very clear. They want to localize the content of Indian citizens in India and not have it sitting somewhere in Palo Alto or Arizona. So given these complexities, I think you will see the consumption, all aspects of the power industry, whether it's generation, whether it's transmission or distribution, having a multi-decadal growth story. So power would be my number one pick as a sector.
Okay, so power, a powerful theme, says Gautam. Got that point. Overall, Gautam, we've discussed the US in great detail. Overall, while you single out power, what about earnings here? Quality of earning? You just told us that, in the US, earnings expectations are getting beaten by 16%.
That's right.
Here, we are struggling to avoid downgrades, though this quarter seems to have been a lot better. We don't have too many earnings casualties. But what's the sense from a growth perspective? Just looking for growth. What could perhaps stand out over the next 6 to 12 months?
So, Surabhi, you raise a fair point that the growth in the States is as high as I discussed, average of 12% for the S&P 500. So if you're an allocator sitting in the US, you think twice about putting money into other markets when your own home market is giving you such stellar results. But having said that, I think there is a need for diversification. So the money will flow into EMs, will flow into India, no question. As far as domestic earnings are concerned, I think, yes, we still haven't gotten out of the dull phase that we've seen over the past about 6 to 7 quarters, where earnings are not able to climb into the double digit. So my view is that we need still more government spending, private sector spending, with the exception of the top maybe 7 to 8 industrial groups. We're not seeing that much spending. Even if you look at the bank's results, Axis Bank loan growth was 8%. HDFC Bank tepid, loan growth of 4%. So 2 of the biggest banks in India are not lending to corporate India, which means corporate India is not necessarily borrowing. And that sort of is a spiral of why we're not seeing that CapEx hit the ground and generate more jobs, generate more production. So of course you've seen Kotak Bank, which had a great loan growth of 16%, but then again, corporate side is only 21% of the loan book. So I think we still have to hope and wait that the government spending picks up. A lot of the research reports that I've been reading over the past few weeks indicate that should pick up momentum in the second half of this year.
Okay, all right. Well, with that hope, we wind up the conversation this morning. Gautam, pleasure having you on. Thank you very much, and very interesting insights coming in there from your US trip. Thank you for joining in. Well, let's stick with the earnings then, and lots of numbers have been flowing in. BEML is the next management on our radar. The numbers came in slightly higher than estimates for the fourth quarter, but the issue is on the order book growth and the revenue growth, because for the year as a whole, FY25, BEML has been slightly shy of its own sort of projections and earlier indicated estimates. We have Mr. Shantanu Roy, CMD at the company, joining in. Mr. Roy, thank you so much for being with us. Really appreciate it. So I just want to highlight for viewers, the order book guidance that BEML gave out at the start of the year was about 18,000 crores. You've ended the year at 14,600 odd crores. And the revenue growth guidance you had given was 20-25%. But revenue growth is very flat. I think for the year, you've not had growth at all. So can we talk about this first? What do you see? Maybe it was lumpiness of orders, had the orders spilled over into FY26. But let's start by talking about growth of the order book and what sort of revenue growth will you expect this year?
Thank you very much. So first of all, let me talk about the order book. Yes, we could not meet the guidance of 18,000 crores, but the silver lining is that the order book as on 31st March 2025 was around 28% more than what we opened the year 24-25 with. And the silver lining was that out of the total order inflow, the 67% contribution was by rail and metro, around 26% by mining. Defense was a dampener. Defense, we could do only around 9%. But if you look at the overall order book position of 14,610 crores against, again, the rail metro sector, it contributes around 63% to it, 24% from 28% from defense, and around 9% from mining construction. There were few headwinds. The orders, the contracts did not fructify in the last financial year, but we are expecting that in the first quarter, some of them would, and by the second quarter, it would to a great extent. As far as the top line is concerned, you see it was more or less flat, I agree, but at the same time, the silver lining is that the PBT and PAT is at an all-time high. So that's a silver lining.
Absolutely. No, sir. No taking away from that. The margin performance has been very good, and we'll come to that in just a bit.
Let us discuss the top line. The top line, basically, we have three business verticals. Last year, the contribution was 43% mining, 38% rail metro, and 19% defense. This year, mining has gone up to 54%. Defense has gone up to 27%. But rail is down by 50%, around 19%. So even though, rail did not perform, but still we managed to have the similar kind of top line. There were certain headwinds in rail, some of the order execution that we were planning, it could not happen because of the proto clearance and other stuff. And also, even though rail is having the highest order book, as I've always maintained in the past as well, there is a gestation period. The gestation period is generally 18 to 24 months before we come out with the first proto. So 25-26, the year when, projects like the Bangalore Metro, even the Vande Bharat, the balanced 9 trains, this will all reach its, Vande Bharat will complete the order. Bangalore Metro will start execution. We are supposed to do 20 trains this financial year. So whatever we could not do last year in rail and metro, it will be made up in the current financial year. And of course, defense, there has been a phenomenal growth. And this year also, we can expect a phenomenal growth in defense.
So, sir, can you just help us put that into some sort of a rough numerical range? Since obviously, these Vande Bharat orders, the metro orders are picking up, you're saying defense is picking up. So for this year, what is the kind of revenue growth we should work with, at least right now? What's the visibility? And what is the kind of order book growth, or maybe an order book number that you can share that you see ahead?
So first, let me talk about the revenue. This is just the beginning of the year. We are in the second month of the new financial year. And what we are looking for is around 20%, again, 20% growth in the revenue. What with the rail projects firing up this year, that should definitely become a possibility. If we talk about the spread or the contribution of different verticals, so in 25-26, we should be having something around 60% by rail and metro and defense, and 40% by mining. Order book, as far as the current scenario, what it looks like, with some spillover orders in the rail and metro. So the current order book of 14,600 crores as of 31st March, we should be hoping to double it in the current financial year. Again, it will be led by rail and metro. 60% contribution will come from the rail and metro. A lot of metro projects which we have already bid for, it will be decided in the current financial year. Some of the rail projects also, like the track machines and all, which we have already bid for, it will be decided in the current financial year. And 20% each from defense and from mining. That is what, it looks like currently.
And so total order book, we should expect, will swell to about 30,000 crores by the end of the current year, right?
I said doubling it. So doubling it should be around 28,000. And from 28,000, we'll be executing some as well. So we should end up the year at around 22,000.
Okay.
20,000. Got it. All right. Hi, Mr. Roy. Good morning. Good to see you, Ben. Let's talk about the silver lining first, as you were stressing on that. Margins have improved for the year, which is heartening. What is the margin target for this year? If you could give us a rough number. You've been talking about margin improvement, so I wanted to understand, where do we end this year with? Point number one. Point number two is exports as a percentage of the mix. With that 20% growth, how much will it contribute to your revenues?
So the margin, if you talk about the EBITDA, we have achieved a growth of around 12 basis points. And right now the EBITDA is around 13.2%. So we are looking at a EBITDA improvement of at least 15 basis points in 25-26. Exports contributed around 8% to the top line in 24-25. So we are looking at something around 10% on the exports for 25-26.
Okay, all right. So I just want to clear the point on margins from around 13%, 15 basis points or 150 basis points. Will it be closer to around 14.5%?
Yeah, it should be. It should be.
Around 14.5%. So around 150 basis points from around 13%, it improves to around 14.5%. Yeah. Got that out of the way. And just one quick question on the working capital days, that as well has got stretched a little bit. Yeah. Receivable days have moved up, inventory days as well have moved up. On a steady state basis, will this cool off?
It will. It will. That is one of our main focus areas. Our aim is to improve the return on capital employed and the return on equity as well. So the return on capital employed, for that we need to bring down our inventory, and we also need to bring down the receivables. Unfortunately, the inventory it was increased because we could not convert, for example, the Bangalore Metro and the Vande Bharat. We were having the inventory, but the sales will start from 25-26. So this year, 25-26, should see a drastic improvement in the inventory levels.
You want to give us the number, working capital days, sir, that it'll take care of the payables, receivables, inventory days. So, if you're talking about improvement, how many days? What does it come down to?
Well, it's very difficult for me to, tell you the guidance for the number of days. But what we are looking at is bringing down the working capital by at least 15% in 25-26.
Mr. Roy, hi, good morning. On defense, could you give us, that's been the topic of a fair bit of intense discussion, whether we're going to see a ramp up in defense business, added thrust on indigenization, and you're very much part of that plan. Could you give us a sense of how that is panning out? What have you seen, especially what have you heard also from the government after Operation Sindoor?
You see, I mean, this current situation, it has been a revelation. India as a country, we as a country, have again proved our mettle. And as a defense PSU, we have been able to contribute in our own way. There is a lot of emergency procurements which will be supporting the government. And our forte is the land systems, the platforms, and we will be supporting the government by way of the platforms. We can expect more numbers of platforms to be manufactured. And that's the reason, we see at least 20%, more than 20% contribution of defense to the order book in 25-26. Apart from platforms, we are also working on, the combat engineering options like the mine flow, self-propelled mine barrier, mine barrier, and there are other mining mechanical minefield equipment which we are currently doing. So these are all related to our core business in the land systems. And apart from that, we will also be looking at diversification to the maritime level. We are already working on some projects as well as contribute to the aerospace sector. So it augurs well for the company. And as a defense PSU, we have ramped up our defense contribution to the top line to an all-time high of 27%. And I can see it growing to at least 30% in 25-26.
And margins here, sir, just 2 points actually. One is on aerospace, what exactly are you doing? Because largely it is land systems, as you said. And second, for this business, will margins continue? Where do they stand, and do you see a continued improvement on EBITDA margins?
Let me first talk about the margins. So margins, as I've already mentioned, definitely there will be improvement. This year, the margins have been driven by two things. One is we were able to reduce our material cost by 0.8%, and even a 1% reduction in material cost adds to the margin in a big way. Second is our sustenance. The sustenance contribution to the top line has been around 26%, and that has been a huge contributor to the margin. So as we grow our sustenance business, I expect the sustenance business to grow by at least 30% in 25-26. So we can expect even better margins. As far as aerospace is concerned, we are already working on several programs with the ISRO, as well as several programs with companies like HAL, and on development projects, mainly for the aerostructures, for the GHE, GACs. And we expect to ramp up the aerospace numbers in 25-26, especially the order book. First is having the order book, and then 26-27, the execution will really start for the aerospace.
So just for our understanding, ballpark, I mean, roughly speaking, are your defense business margins lower than metro and rail? I'm guessing metro and rail would fetch you the highest?
Again, that's a very difficult question. Metro is an intensely competitive market. Rail, I would say, commuter rail, the mainline rail, it has got better margins, but metro also, definitely we have the margins, but I would say it is in single digits. Defense, definitely, again, there is intense competition as well. In fact, more than 87% of our top line is from competitive business. So defense, along with high-end mining and the commuter rail plus the sustenance, it adds up to our margins. It helps us in improving the margins. So more we do of these things, better the margin.
The better the profile. Got it. So the commuter rail segment, high-end mining, and some specific defense and aerospace projects.
Specific defense, aerospace, and sustenance.
Got that, sir. Thank you very much. Great conversation, and we wish you good luck for the rest of FY26. Quick break right now. Come back on the other side, and we'll have the management of JSW Steel joining in to talk about the fourth quarter performance.
Welcome back. As promised, let's get chatting with the management of JSW Steel. The numbers were in line and the performance should improve from here on. We're joined by Mr. Jayant Acharya, the Joint MD and CEO at JSW Steel. Hi, Mr. Acharya. Thanks a lot for joining in here on CNBC-TV18. Well, let's start off with focus on the domestic front. How is demand on ground? And also tell us how much higher are prices today if I compare it with the past quarter?
JSW Steel has delivered a very strong operational performance, as you rightly said, on the back of a very strong India demand. Last year, the demand in India grew by about 11.5%, incrementally 16 million tons of steel. The pricing improved towards the later part of last quarter, And I think the benefit of that we will see in the Q1 of this year. So we see an improved pricing environment, giving us a positive flip side on the price realizations in the Q1 2026. It will also be driven by higher volumes from our JVML capacities at Vijayanagar, which has ramped up to about 90%, over 90% plus utilization in March. That will further improve in terms of volume, as well as with stabilized operation, it will be more cost effective than all our other operations in our hot rolled coil business.
If you could give us a number, sir, how much higher prices on an average for this quarter versus the last one?
I think we would be expecting in the vicinity of 3,200, 3,250 rupees per ton.
All right, got that. Let's focus on the other aspect, that's on the cost side. How much lower were coking coal cost in Q4? And how much lower will they be, say, in the coming quarter, Q1 FY26?
So last quarter, as we had guided, our coking coal prices were lower in the blend by about $15. And we expect about $10 to $15 in this Q1 as well, on the back of better sourcing and blend.
Okay, Mr. Acharya, hi sir, morning. Great to have you on. What is the outlook on your overseas operations?
Yeah, so overseas operations have improved over Q3 and Q4. I think especially on the back of a better pricing environment in the United States, we will see better, I would say, improved operational performance in Q1 versus Q4. Italian operations, there was a delay with the uptake of some orders from the rail system. And we also faced a congestion in terms of evacuation of the rails from our plant. So due to which the volumes were lower and that resulted in a lower EBITDA. On an outlook basis, I would say both US operations and Italian operations will deliver positively to the EBITDA in the current year. And the bilateral order from the Italian rail in Italy is in the process of getting signed. So we would see improved offtake in this year from the Italian rail.
Mr. Acharya, but will US and Italian operations turn into the green in this quarter, first quarter of 26?
It should be contributing to the overall EBITDA.
Fair enough. What's the outlook on capex and debt in this financial year, FY26?
Yeah, so we have a plan of spending about 20,000 crores in this financial year in FY26. And as you have seen, our debts have gone out by about 4,350 crores in the last quarter, ending March 25. Going forward, I think rather than a debt number, I would like to say that our ratios, net debt to EBITDAs, which have improved from Q3 to Q4, will continue to progressively improve during this financial year.
All right, sir, I want to question you on the fundraising plans. Any such plans? You'll have taken a couple of enabling resolutions, but will you raise some money?
Yeah, so certain dues which higher cost debt and some things become due, so we keep on refinancing. So those instruments we'll raise through various instruments of the market and refinance those for a better cost-effective interest rate.
All right. Besides the numbers, sir, the focal point is going to be on Bhushan Power and Steel. What is the course of action you all are taking with regard to that particular asset?
Yeah, so the matter is sub judice, so I may not be able to comment too much, but I think it's important to note that we have implemented the resolution plan in full compliance with the law. And we have been able to successfully revive the asset to its present condition where it is today, with increasing operational output, with increase of capacities. The second thing is that we have analyzed the judgment along with our legal advisors, and we believe we have strong grounds for availing all legal remedies available to us.
So it's really important you say that, because I believe that I think there's a plea coming up in the NCLT today from the single side. So what is the current status? Have you approached the courts? Are you planning to do that?
So I think those are under various stages of discussions with our advisors, and we'll be taking appropriate steps at the right time. I may not be able to give you exactly what the status is in the court as of today.
Okay, we'll just wait by for developments on that front, sir. In case this asset comes up for bidding again, if there's a fresh bid, will you be able to participate? Will you participate?
Yes, but the laws, yes.
Okay. And what's the amount that JSW Steel is due to get in case the asset goes for liquidation?
Yes, so two things. On the downside, as per the Supreme Court judgment as well, we are protected from the fact that the refund would come back to us, number one. Number two, the capacity expansions in BPSL have been done from the internal accruals which we generated at BPSL as per the resolution plan.
Okay. All right, sir. But what is the rough amount that JSW Steel is looking to get in case of liquidation?
So we will be getting the refund of whatever amounts we have paid. And I think at this point of time, that is all we can say.
Okay. All right, Mr. Acharya, final question before we let you go. As you said, you'll be eligible to bid if the asset comes up for rebidding. But will JSW Steel be rebidding for the asset? Can we assume you will be going in for it?
I think that is something which we will take a decision at the right point of time. As of now, as I said, we are pursuing all legal remedies which are available to us. We believe we have strong grounds and we have a strong case.
Okay, well, Mr. Acharya, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here on CNBC TV18. So that is JSW Steel in focus, and of course towards the end that case which is going to be very much in focus going forward as well. Now the 2,800 crore rupee IPO of the chemicals and oil storage and logistics solutions provider Aegis Vopak opens for bidding today. We have Mr. Murad Molidina, non-executive director at Aegis Vopak Terminals, joining us here in our studios. Sir, good morning. Great to have you with us here.
Yeah, hi, good morning.
Thank you very much. Strong demand as far as the anchor book is concerned. So
yes,
congratulations. And I think we'll see what the retail demand is like.
Let's watch.
But it's a specialized business, and we'll get to financials, etc. But for our viewers, if you can just start by, you operate terminals for liquid storage, which is chemicals, etc., or also LNG, right? Just describe the business for us at a very basic level.
Let me explain in very simple terms what is the business. So business is setting up storage tank terminals at ports to receive, store and deliver liquid cargo as well as LPG, not LNG. And in liquid cargo, we can store various kinds. We can store petroleum, petrochemicals, chemicals, veg oil, and there is a lot of flexibility. This is a very niche business, like you said. It requires special skill set. It's not a plug-and-play business. So you set up at a port. These cargo come in bulk. So it's 5,000 KL. 5,000 KL means 50 lakh liters or 10,000 or 45,000 also, which is 450,000 or 450 lakh tons. And you have to unload it within 48 hours, store it, and then deliver as advised by the customers, whether by road, filling up road tankers, or rail, filling up rail wagons, or even delivering via pipelines, as the customer would want.
The liquid part is mostly hazardous stuff, or is it?
It's all kinds. Like I said, even veg oil. I mean, these liquids could be of a temperature as high as 300 degrees centigrade. Now, 100 degrees water boils. Or it could be the other way around, LPG, minus 40 degrees centigrade, like more than an ice cream.
Okay.
So various temperatures.
So these usually come in these ISO tanks, right? I mean, or,
no, they come in bulk. So
okay.
the whole ship is filled with those liquids. We have a marine loading arm like a crane, hooks into the ship, sucks the product, jetty pipeline brings it to the middle, which we call stomach part, where tanks are there.
Okay.
And then you deliver.
Okay.
So I just wanted to understand the competition as well, because, there are a lot of port operators with storage facilities. I'm guessing Adani's as well to an extent, they're in the same line of business.
Yep.
How unique, basically how strong is the moat? And the customers, wouldn't they have other options? What about the, the competitive intensity?
Let me just start with the customers. If you look at my DRHP, 93% plus are repetitive customers. We are pioneers. 1978, we started this business. And there is a huge customer relationship. My partner, Vopak, has been doing this business last 400 years. 23 countries, very deep-rooted customer relationship. Here, my name, Aegis, is a Greek word which means to protect. So this business is not about competition. This business is how do you build the efficiencies. So we have an in-house infrastructure construction ability to construct the infrastructure quickly and cheaply.
But JSW and Adani, they're big groups.
So
they do count as your peers and competitors, right?
Yes. So they are a little bit different because they are port. So they will build the infrastructure where they are having their port. I go and put up terminals at various ports. That is the difference which makes us a little different. And also the care. This is not a plug-and-play business. And I would crudely say this is not a business of deep pockets because you need to be doing this all the time. It's not like a sidekick business. You have multiple business and one of the businesses is terminal. So we are not doing anything else. No road, no Swiggy, no Zomato, no EV.
Okay, all right.
Focus.
Full attention.
Yeah. All right. Good to have you, sir, in the studio. We here at CNBC-TV18 request you to come more often. I think you require an IPO to get the management of Aegis Logistics to the studio. That aside, let's focus on this issue. It's not very, very cheap. I know that the anchor book is strong. But if I do a valuation parameter, not very, very cheap. So we'll have to see, the returns that investors get. But otherwise, the listed stock Aegis Logistics has given very, very good returns over the years. Few basic points now. You're raising some money by the fresh issue. The debt number is going to come down, right? What is the rough interest savings that you will be getting?
Correct. So let me just give you 4 important points of this public issue. One is that bank borrowings are going to become zero. So 2016 crore are going to be repaid.
Okay.
You take an average 8% interest rate, 160 crores. 9 months number are 85 crore PAT. So you look at the borrowing reduction that is going to happen and how much that is going to change my PAT.
Okay.
Number 2 is that my 2 liquid terminals have just become operational in March, which is a JNP in Newport, as well as Mangalore expansion. And then 2 cryogenic terminals at Mangalore and Pipavav are getting commissioned in H1 of the current year.
Yes.
So they are like factories. I have 22 working sites. I have developed 225 acres of port land in 6 ports. And these are going to triple my LPG capacity, the 2 cryogenic which is going to come. Plus the fact you just have to understand that these terminals work on turnarounds.
Right.
So if I have multimodal evacuation started, my utilization would step up.
Right.
So we are just getting hooked into Jamnagar-Loni pipeline, Kandla-Gorakhpur pipeline with our existing terminals also. So all of this is happening in the current FY26 and you will see a marked...
So very, very basic question. Gas terminal and liquid terminals. Which fetches you better margins, better ROCE? Just bare basic, brass tacks question.
I'll give you a very easy example for that. Both are crazy. And I'll give you LPG first. LPG, my capex cost under DRHP, CRISIL, independent agency, has reported is one of the lowest, 1/3 than the peers. And it is around 1,200 rupees per metric ton of my capacity. My revenue yield also in DRHP is 1,250 rupees. Okay, 88% is the EBITDA. So I can go up to 80% of my capex cost as EBITDA. So even if I start with a low utilization, it's big EBITDA. And then you grow as the volume grows. In liquid, it's all about change of product mix. It is like this. If you go, and I'll just take a second. If you go and check into a hotel, your checkout time is 12 noon. But your flight is 6 a.m. Will you wait till 12 noon? No. Same year the product, the rates are monthly. If I find products which evacuate faster, I can get another set of products. Another example, in the same hotel, Virat Kohli checks in, I check in. The rates are different because he needs a little more attention. Similarly, in my terminal, if an acid comes and a petrol comes, different attention, different price.
You're explaining it very well to potential shareholders, I must say.
So you get huge product mix potential.
Right. Mr. Molina, what are the variables which affect your business? I mean, is it just demand? Is it... And all of the stuff which is coming in, it is for use here within the country, or this is transshipment? I mean, it's going ahead.
So we are, I always tell people, and I say it very crudely, the most 40% on ground is ages, because we are very conservative and risk averse, right? So how we make our infrastructure makes us different. So I said we construct our infrastructure quickly. I take 12 months for liquid, 18 to 24 months for gas. Look at anyone else, they will take far longer. Second, I construct it cheaper than others. So I get back my money faster. Life of the asset is 40 years. Third, what I do is I make it flexible. So I can change product. Fifth, I make this terminal trade neutral also. So I can handle import, export as well as coastal movement. So let's say tomorrow Government of India says no more imports. Then what happens to my infrastructure? I can do exports, I can do coastal movement also. Jamnagar refineries will cart their petroleum products all the way to Kochi to distribute. They will not fill up 20-tonner trucks, so many of them, and then it takes so long to... With GST creating a common marketplace, it's been a blessing. So this business is, you have to make it very flexible. You have to ensure that sustainable growth is there for the 40-year life that your asset has. And that is, just lastly I should put in, is that we do not rush into a port. There are 219 ports in India, 19 major, 200 minor. I'm only in 6. I go after demand. When there is a sustainable long-term demand, do I go and put up my infrastructure?
Let's focus then back on numbers. You told us about the debt repayment, the Mangalore cryogenic terminal. 670 crores will be going towards that. So what are the matrices you're working with out there? Volumes, EBITDA contribution, what could that be?
Those are a little bit forward statement, but I can give you this way. That the terminal is capable to do 6 million tons of throughput.
Okay.
My rate of revenue is 1,250 rupees. I have spent only 900 odd crores for that terminal.
Okay.
Now, as the utilization will ramp up in 5-7 years, I would be reaching that peak.
Okay.
So you take your take that what a potential that terminal has. Because I will not be able to step into that forward.
All right. So when you list, then we'll push you more for those numbers. But final question, you have said Vopak quite a few times, and that's a big name globally. This is a fresh issue. But at some point of time, Vopak may want to take some money off the table, or will they be locked in for a few years?
Superb. So we have done a 3 years lock-in sort of inter-se agreement, part of DRHP. So we have taken into account everything.
So Aegis as well as Vopak, both will not sell?
Yes, both.
Both will not sell for 3 years. They're locked in for 3 years.
It's a joint venture.
So then you'll have to find a way to, you'll have to do another fresh issue to bring down the shareholding from...
Primary. What it does is, primary issue resets your debt to zero and makes your eligibility more because equity is pumped in.
Okay.
So it's a double whammy in the sense that you get more eligibility, so you can do more capex, and then you have again made it.
All right, we have got all those points on board, sir. Our only point I would like to say is that valuation is not very, very cheap, but you seem to be having a good pitch, as you've told us. And in fact, we look forward to chatting up with you on
Thank you so much.
Thanks a lot for coming down. Well, time to get in our technical expert. I think we have Sudeep, who's joining in from SBI Securities. Sudeep, it's been a good start, a good Monday morning for the Bulls. What's your take?
Good morning, Nigel. A fantastic Monday followed by a superb Friday. So while we were a bit jittery on Thursday evening while the markets were approaching 24,600, 24,550 zone thereabouts, but taking support from that 20-day exponential moving average, we have seen a stellar pullback from those levels. And what's more encouraging is that the rally has been now backed with, say, select IT names, banking, as well as caps and the small caps. So it's kind of a broad-based rally, and that is giving us more confidence that we could see this rally expanding probably towards 25,300, 25,500 on the upside. On the downside now, supports are rising closer to 24,850, 24,900. Looking at the today's morning derivative data, 24,900 as well as 25,000 puts are seeing aggressive writing, as well as we are seeing some serious call unwinding right from 24,750 to 24,950 series. So what we feel is that now the supports are rising and 24,850, 900 could act as a strong support from here on.
Okay, what about individual stocks, Sudeep?
From an individual stock perspective, a couple of stocks are there on my radar. One is from the large cap space and one is from the mid cap space. From the large cap, it is Axis Bank. Since we are seeing Bank Nifty breaking out above 55,500 and seems it's heading towards 56,300. So Axis Bank here post a 3-4 week consolidation between 1160 and 1210 has finally broken out with volumes, and we feel from the current levels this stock is headed up to 1300, 1320 levels on the upside, and on the downside 1180 would act as a strong support. The other stock that is there on our radar is Hudco. Now, a lot of these names, Hudco, NBCC, are on that breakout list, and today finally we have seen Hudco breaking out with volumes. The stock has sustained above its 200-day moving average since last 5-7 sessions, although it was a bit wobbly and choppy. But today's price action suggests that from here on, the stock is headed up to 250 to 55 levels on the upside and could be bought with a stop loss at 228 on the downside.
All right, we leave it there for now. Thank you very much for joining us. Good getting that perspective on board. And technicals and price action, really. Now, just a reminder, we are excited to unveil our brand new global business news channel. CNBC-TV18 presents an all-new CNBC-TV18 Prime, a channel that will provide live and in-depth coverage of global markets and economic developments through an India-first lens. In our inaugural episode of The Global Reset, it's a show which will air at 12 noon every day. You will listen into Rajiv Jain, who's chairman and CIO at GQG Partners. Remember, GQG is by far the largest foreign investor in India. That's the inaugural first episode, which airs at 12 noon today. Do tune in to CNBC TV18 Prime.
Welcome back. Let's focus on the paint space. And Indigo Paints, well, they reported a pretty much subdued set of numbers on the growth factor for the fourth quarter. The company has witnessed sluggish growth across its segments. To help us out with how things are panning out, Mr. Hemant Jalan, the chairman and MD at Indigo Paints, joins us on the show. Hi, sir. Good morning. Always good to hear your thoughts. Well, the quarter was a little bit subdued, but the stock price is up close to around 2%, telling you the markets are looking ahead. So give us a couple of guidelines. What kind of revenue volume growth are you looking at for FY26? And if you could help us out with what's the guidance on the margins as well from here on?
The reason why I think the stock market could be possibly rallying despite subdued performance is because you will notice that for all the paint companies, Q4 has been significantly better than Q3. Now, I'm not saying that Q4 are a great set of numbers, but at least the improvement in the demand situation is in sight. And as we speak, when we are more than halfway into Q1 of this year, we see a further improvement in the demand situation and the sentiment happening. So I think we are only a few months away from hitting back to the normal demand scenario when the industry would grow by 7-8% and we would grow by more than 20%. So I'm hopeful that situation would come about from at least Q2 of this year. But I think you'll see improved numbers on the top line from all the paint companies in Q1 is what my expectation would be.
So, and for you, sir, what kind of a revenue growth can be penciling in for the year, given that demand's going to come back? And also, tell us on the profitability. And when we're talking about your margins, ad spends as a percentage of the mix, that obviously comes up because it's around 6%. Where does that number stabilize at? Revenue, margins, ad spends as a percent. 3 points. Please go ahead.
I would be wary of giving a guideline number as far as top line or bottom line growth numbers are concerned, because we are in the midst or just getting out of the longest spell of weak consumer sentiment that anyone has seen in the last 25 years. So although the signs are good, we can see some improvement. Exactly how long it will take for this improvement in the demand scenario to come about is a little difficult to forecast. And therefore, I think we'll have to wait and watch until the demand does come back to its, shall I say, normal levels that used to exist before the last 15 months. Once that comes, we would be happy to give a number guidance. But as far as profitability is concerned, if you notice the whole of last year, I mean, we have only done less than 2% of top line growth, but the bottom lines have pretty much held up. And in Q4, we have done our all-time highest EBITDA number of 23.4% and our all-time highest PAT margins of 15.1%. So I think there is some softening in the raw material prices, which has been continuously happening over the last 5 or 6 months. It looks like that will continue going forward. And that, aided with a little bump up in the demand, I think should see the margins holding fairly steady, if not going up as we move forward.
So, Mr. Jalan, sir, hi, good morning. Two-part question. When you say demand normalizing, because it's been quite a while, several quarters. So when you say normalizing, would you consider 10% growth in a year as normal or single digit as normal? And how far away do you think we are right now from that normal?
So as far as the industry is concerned, and I'm not talking about Indigo Paints, the norm for the industry has been anywhere from a 7 to 9%, top line CAGR, and that has pretty much existed over the last 10, 15 years. So that is what I would call a normal demand scenario, where the industry starts growing at anywhere around, let us say, 8%. Obviously, you have been seeing for 5 quarters in a row, the industry leader has been at negative of 5 to 6%, sometimes a little more than that.
Yeah.
So that is very obvious that.
So do you see, sir, the industry, like you're not giving numbers for Indigo per se, but do you see the industry, paint industry, come back to that growth of at least 8 to 9% this year?
Oh, certainly. I'm hopeful that it will come by the end of the second quarter. We can see the gradual recovery happening. It's not a hockey stick recovery. It's a gradual recovery, but it is consistent month after month. So I think it will inch back to its numbers by August, September.
Okay.
I'm hopeful that it will happen earlier, but I can't bet on it.
Okay. Last question, sir, before we let you go. Your market share is at around 3%, but you are adding capacity as well big time, the Jodhpur facility. Could you tell us where do you see your market share headed from around this 3% in the next, in the next 3 years or so?
The next 3 years, if we can take it to 5%, we'd be very happy.
That would be the aspiration?
Yeah, that would definitely be the aspiration. And all capacity increases are done with a long-term view in mind.
Okay.
And we expect that we would start utilizing those capacities meaningfully in the next 1 or 2 years.
And this expanded capacity, the 2 upcoming plants will enhance your capacity by 80%. What would that mean in terms of revenue potential?
I don't think in the paint industry you can equate capacity to demand or top line.
Okay.
I think that the two are totally independent of each other. Capacity expansion is done with a long-term view when you feel that 3 years down the road, you may hit a bottleneck. But increase in capacity by itself is never a precursor for increase in top line. It's the other way around.
Got it. Okay, all right, sir. Thanks a lot for joining in and filling us in with all of those details. Looking forward to chatting up with you as the course of the year progresses. For the time being, we slip into a short break. On the other side, we'll be joined by Francisco of Bank of America Securities on global commodities market. Stay with us.
Okay, welcome back. As gold and copper prices came off their all-time highs, which they hit earlier this year, markets continue to react to tariffs and geopolitics. My colleague Manisha Gupta caught up with Francisco Blanch, head of Global Commodity and Derivatives Research at BofA Securities, began by asking about the recent correction in precious metals. Listen in.
Look, we've been calling for $3,500 gold for the first half of this year. We got there, and we feel the market's going through a correction right now that could last a few months. Now we're still bullish longer term. We think longer term, maybe into the second half or into 2026, we'll breach $4,000 per ounce. But we're going through a correction because some of the extreme uncertainty that we've witnessed in recent months seems to be fading. Of course, it could come back. As we know, the Russia-Ukraine war, which was potentially heading into a ceasefire, into some form of peace deal, seems to be getting farther away from that. Also, we've heard about potential additional tensions between Iran and Israel. And then there is the negotiations around the U.S. budget in Congress. So I think we've hit a couple. We've gone very close to 2,500 a couple times, but to breach that level and keep moving up, we need some of this geopolitical turmoil, some of this policy uncertainty to creep back up again. And again, we expect it to happen into year end and into 26. But for now, we think it's unlikely we will move up in a straight line from here.
Francisco, I know you do not look at cryptocurrencies or Bitcoin for that matter, but we've seen an all-time high in Bitcoin as well for the week. In relative to other asset classes, and because it's the same money moving everywhere, how do you see this money deployed into cryptocurrencies?
Well, I mean, again, this new Trump administration has been very friendly to crypto, so I think that's likely enticed investors to go into crypto assets. We've also seen, of course, a rotation away, as I mentioned, from U.S. Fixed income securities with the U.S. Downgrade, U.S. debt downgrade last Friday. And I think also, said frankly, even the equity markets are no longer as attractive as they once were because of the uncertainty around tariffs and the pressure from the White House for companies to effectively eat the margin squeeze and not pass as much of the import cost into consumers. So all of that has created if you like, a bit of a cocktail for investors to look for alternative assets. And I think that's where crypto has been shining, coupled with, like I said, the more lax approach on the regulatory front to crypto.
I want to talk about silver as well now, and a fifth straight year of deficit, but the prices haven't really moved with the fundamentals. The industrial demand also seems to have taken a bit of a backseat, not the same record numbers that we saw in 2024. How do you see the silver demand availability going forward, and what's your price sense?
Well, in silver, we are looking at $40 per ounce. We think silver is one of the better investments because, of course, remember, silver is half precious, half industrial. And the precious aspect of silver has been driving it higher. The industrial side has been taking a back seat. But this will eventually change. Of course, tariffs mean weaker trade conditions. And we had a pretty strong trade window between the fourth quarter and the first quarter of last year and the first quarter of this year, where investors were buying in anticipation of tariffs. Now we have the tariffs, so we're going to go into a slower period, which will last for a quarter or two, and eventually we will see another pickup in industrial activity. And again, if you are to model silver, the main drivers are, of course, the price of gold, because silver is largely a precious metal, but also what's going on with industrial activity. And right now, industrial activity is going to be weaker, so that's one of the reasons silver has lagged on the move up the large upward lifting gold prices. It's really the weaker industrial backdrop we're seeing today. But we like silver. It's linked to solar panels. We still expect enormous investment in solar panels and in the electrification of everything. And we think silver plays a critical role. Remember, silver is the best conductor, the best electricity conductor in the world. So it's going to play a very important role. And we think going forward, once we go back into a more stable industrial activity environment, silver will shine again.
Since you are bullish on silver, Francisco, are you equally bullish in other base metals as well? Copper, for example, or aluminum for that matter, or a zinc, which has absolutely underperformed in 2025 till time?
Right. So those three industrial metals are a little different each. We like copper into next year. We think eventually we'll reach 10,500 and eventually $12,000 per ton. It's more of an 18-month view. The one thing in the short run, as I mentioned, is that we remain concerned about cyclical conditions, right? I kind of hinted at that in my comments on silver, but the cyclical demand drivers are weak, and they're weak because tariffs are sand on the wheels of the global economy. It's hard to believe that after all this tariff turmoil, we are not going to see lower growth. How weaker growth we're going to see is the question. Is it going to be, are we going to lose 0.3, 0.4, 0.5, 0.6 percentage points of global GDP? I don't know, but it'll be somewhere around that level. And this is also likely to impact industrial activity. So in the short run, we are a little cautious on industrial metals. Now, looking out, as I said, we are pretty bullish on copper because we think, again, copper is the second best conductor, and we are electrifying everything. So it's a big demand story. China's also putting a big stimulus program in place to counterbalance the tariffs, and there's true scarcity in ores, right? We've seen the refining charges going negative, meaning that basically miners are just getting the copper ores refined for free, pretty much, right? So it's an interesting market where there's scarcity at the base of the raw material, the copper ore, and therefore that's translated to firm pricing action. So we like copper. Aluminum, a bit of a different story. It's a metal that again is becoming more regionalized. The U.S. has imposed tariffs on aluminum imports, 25% tariffs. It's big numbers, right? President Trump wants to bring tariffs, wants to bring aluminum production to America. The problem aluminum has, Manisha, is that it takes a lot of power to make a ton of aluminum, exactly 14 megawatt hours. And that's one thing America cannot get enough of because of all the investments in artificial intelligence. We've heard from aluminum smelters in America that shut down a few years ago. They're like, well, will you reopen? They're saying, well, actually, we're thinking of selling our entire facility to an AI data center. Because it just takes a lot of power. The U.S. would need basically 7 new nuclear reactors to do that. And then for zinc, zinc is used mostly in galvanized steel. And as you know, the steel market has been lagging a little bit. Galvanized steel is basically to avoid corrosion. What's going on with zinc is a little, we have a softer steel market in China. It's linked to construction. Construction in China has been weakening up quite a bit, and there's a little more supply. So zinc hasn't underperformed the rally.
Very clearly. I'll come to energy markets now, and we've seen crude oil prices quite volatile as well. On one side, it was about drill, baby, drill. That's how we started this year. But if you look at the markets right now, the shale gas numbers, the oil and gas rig numbers are not so strong there. We've seen OPEC continue to increase production. The U.S. production is near record highs as well. It's a particular case of more supplies, even a surplus, and a weaker demand. How would you look at the crude oil prices within this?
I think you framed it really well, Manisha. We have a trade war which is pushing industrial demand down, and it's also pushing cyclical drivers down for oil. And on the other hand, we have a price war. OPEC is adding barrels at a time when the market doesn't need those barrels. And of course, next week, we're going to see another OPEC meeting. There's talk about potentially another outsized increase of 411,000 barrels a day. Remember, OPEC's already committed to adding 960,000 barrels a day in just about 3 months. That's a lot of oil. Now, granted, Some of it was already there, and some of it is just marking to market what producers like Kazakhstan and Iraq and others are already pumping above quota. So it's not a true increase of that size. But nonetheless, OPEC keeps adding as prices keep falling. Where is OPEC going with this? In my mind, there's three reasons why OPEC is adding barrels. Reason number one is market share. Reason number two is discipline, applying discipline to other members. And reason number three is trying to push down U.S. inflation. Is if you like, OPEC contributing to bring down some of the inflation we've seen in America on the back of tariffs. And which one is the reason? I don't fully know, but there is. I think market share is clearly a very important reason. Saudi Arabia has the lowest market share, not just against the rest of the world, but also within OPEC that it's had in decades, and it's trying to bring its production back. Right? Why is it doing it now? Why is it doing it fast? Maybe there's an element of discipline, and why now is maybe there is an element of trying to contribute to reduce U.S. inflation as, if you like, as a gesture to President Trump, which has been asking the group to increase output. So this means U.S. shale supply is going to flatten out. We expect a high oil plateau in the U.S. We expect production to really kind of stop growing. It's not going to fall at these price levels, but it's not going to grow either after 3 years of very fast growth. And at the end of the day, why is OPEC adding production? Remember, main reason is for the last 3 years, we averaged almost $90 a barrel, and U.S. shale production grew by 3.5 million barrels a day. OPEC is saying, enough, we're not going to keep oil this high. Instead, we're going to bring more volume. And rather than having 6 million barrels a day of exports at $90 a barrel, we're going to have 9 million barrels a day of exports at $60 a barrel.